When foreign investors establish a company in Vietnam, one of the first operational decisions they make is choosing an accounting firm, and in many cases, that decision is based mainly on price. The lowest quotation, the fastest onboarding, or a recommendation from another startup. At first, this may appear practical, but for many foreign-owned companies in Vietnam, choosing the wrong accounting provider later becomes one of the biggest hidden compliance risks inside the business. Because accounting in Vietnam is not simply administrative bookkeeping, it directly affects tax compliance, licensing, payroll, audit readiness, profit repatriation, and the overall legal stability of the company itself. Many local accounting providers in Vietnam are familiar with small domestic businesses, but supporting foreign invested companies requires a very different level of capability. FDI companies often involve foreign shareholders, cross-border transactions, intercompany arrangements, English communication requirements, foreign contractor tax issues, payroll for expatriates, and more complex compliance expectations. An accounting provider that lacks FDI experience may still complete basic filings, but over time, hidden compliance weaknesses can begin accumulating beneath the surface. And unfortunately, many foreign investors only discover those weaknesses during audits, tax inspections, or expansion planning. One of the most common mistakes foreign investors make in Vietnam is assuming accounting services are largely identical. As a result, providers are often selected based almost entirely on low monthly fees, but low-cost accounting structures frequently create higher long-term risks. Some providers focus mainly on mechanical tax filing. Communication may be slow or unclear, supporting documentation management may be weak, and proactive compliance advice may not exist at all. As long as operations remain small, the problems may stay invisible. But when the company grows, undergoes audit, applies for licenses, repatriates profits, or faces tax review, weaknesses inside the accounting structure become highly visible. At that stage, correcting the issues often becomes far more expensive than choosing the right provider from the beginning. For foreign-owned companies in Vietnam, choosing an accounting firm should be viewed as selecting a long-term compliance partner, not simply a low-cost vendor. One critical factor is English communication capability. Foreign investors must be able to understand compliance risks clearly and receive explanations they can actually rely on. Another important factor is practical FDI experience. The provider should understand the operational realities foreign-owned businesses face in Vietnam, including tax compliance, payroll structures, audit preparation, and cross-border transactions. Transparency also matters significantly. A strong accounting provider should explain issues clearly, respond proactively, and maintain proper documentation discipline rather than simply filing reports mechanically. Because in Vietnam, accounting problems often become legal and operational problems later. Many foreign investors focus only on technical accounting capability, but responsiveness and professional ethics are equally important. When tax authorities request clarification, when auditors ask questions, or when management needs urgent compliance guidance, delays in communication can create serious operational pressure. Some accounting providers disappear when problems emerge, others avoid explaining compliance risks honestly because they fear losing the client. This creates dangerous situations for foreign investors unfamiliar with Vietnam's regulatory environment. A reliable accounting partner should not simply process paperwork. They should help management understand risks before those risks become liabilities, and they should maintain transparency even when difficult compliance issues arise. Imagine a foreign entrepreneur establishing a small technology company in Vietnam. At the beginning, minimizing costs feels important. The company selects a low-fee accounting provider recommended online. Monthly reports are submitted. Basic accounting work appears completed. Management assumes everything is functioning properly. But 2 years later, during annual audit season, problems begin appearing. Supporting documents are incomplete. Payroll records contain inconsistencies, several tax treatments were handled incorrectly, and communication with the accounting provider becomes difficult once auditors start asking questions. The company then faces additional accounting costs, audit delays, and potential tax exposure that could have been prevented much earlier. This situation is more common among FDI companies in Vietnam than many foreign investors expect. When entering Vietnam, many foreign investors focus heavily on incorporation and licensing, but long-term operational sustainability depends heavily on compliance management after setup. A strong accounting provider helps protect the company's operational credibility over time. Good accounting structures improve audit readiness, reduce tax risks, support smoother banking relationships, facilitate future fundraising, and help management make more informed business decisions. In contrast, weak accounting structures often create hidden instability that becomes visible only when the company faces external scrutiny. At LTS Law, we regularly advise foreign investors who encounter legal and operational problems caused by weak accounting structures. This is why we believe accounting provider selection should be treated as a strategic business decision, especially for startups and SMEs entering Vietnam. Although LTS Law does not directly provide accounting services, we help foreign investors identify accounting and audit partners that have been professionally assessed for FDI capability, English communication standards, responsiveness, transparency, ethical conduct, and practical understanding of foreign-owned business operations in Vietnam. Our goal is not simply helping clients establish companies, it is helping them build sustainable business structures after incorporation. Many foreign investors only realize the importance of accounting quality after compliance problems begin affecting the business. But by that stage, correcting structural weaknesses becomes far more difficult and expensive. At LTS Law, we help foreign investors understand that strong compliance starts with choosing the right partners from the beginning. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on selecting suitable accounting or audit providers, book a consultation with LTS Law. Because in Vietnam, the accounting firm you choose today may determine the compliance risks you face tomorrow.